This is Ralph Sass, and this is the second part of the lecture for Chapter 8 on inventories, cost of goods sold, as well as a couple other topics. So let's go ahead and get started. We left off with goods in transit. Um, we can use both a perpetual or a periodic system, and most companies today use a perpetual system, and in a perpetual system, you always have access to how much is left in inventory. Under a periodic system, you don't have that type of knowledge of what's currently in inventory. Um, mo More and more companies have gone to a perpetual system. I work with some small companies, even some small companies have gone to a perpetual system because they want to know how much is left in their inventory. Old school, some businesses are probably still on a periodic system. And in a periodic system, you do things a little bit differently. First of all, rather than debiting inventory, you debit an account called purchases. Purchases is an account that will be closed at the end of the accounting period, but it's just a different way of doing it, and you're not keeping track of um, what particular items are in your inventory. I should also point out at this point, under a perpetual system, you can use specific identification, FIFO, LIFO, or average. Under a periodic system, you can use any of those four methods. When you sell something under a periodic system, and we saw this in Chapter 6, there is no journal entry to get it out of inventory because you don't have an inventory account. That's what makes this so problematic, even for small business, is that when somebody comes in and asks you, do you have any of these in stock? You're going to have to go back to the shelf and look, and if they're not on the shelf, you may have to go back into the warehouse or your storage room and check, and you don't necessarily know. So that becomes the problem with periodic systems, but there is no journal entry to record the sale when you sell them. All you do is record the sale. Here's a particular item, and notice what we have. We have a beginning inventory of 10. We've purchased numerous items during the year for a total of 30 units. We've just done an inventory and we have 12 units left. And that means that we sold 18 units. 30 minus 12 is 18. Notice the cost per unit was always different and the total cost was different. And notice we kept no track of when the items were sold. So now under specific identification, we're going to have to know which 12 units are left. I think it's probably highly unlikely that a company using specific identification would use a periodic system, but if they did, they would know exactly what 12 were left in inventory, and that would tell them. And how would they know what 12 were left in inventory? Because they did a count. Okay, they went and counted the inventory. They saw which models were there, which, VIN numbers were there, or what have you. They know what 12. And notice, since they knew that there were a total of $3,000 worth of goods available for sale, they went back and counted, and they had 1,240 sitting there. They know that their cost of goods sold is 1,760. Under the average cost method, notice what they're going to do. They're going to take the $3,000, which is the total, divided by the 30 units, and that's $100 per unit. So now, since they have 1,200 units, they have 12 units left, each one is valued at $100. They're going to just take the 12 times 100 and come up with $1,200 as their ending inventory. And likewise, because they sold 12, they have 12 left in inventory, they sold 18, they're going to multiply each of those 18 by $100, and $1,800 will show up as their cost of goods sold. In FIFO, the first ones in are the first ones out. So those 5 units, okay, so what they've done here is they've said we have 12 units left. And what they did is they said we have 12 units left. Since we have 12 units left, what they did is they started with the most recent ones, and we said of the 12 units that were left, 5 of them were obtained on December 1st at 130. I've now accounted for 5. I need to account for 12, so I have 7 more to account for. They go to the next purchase, which was on October 1st, and we say those 5 units that we purchased for 120 are still left. Now we've accounted for 10 units. We need to account for 12, so they account for the 2 additional units that were purchased on July 1st. Because of and those were each purchased at $100 for a total of 200. So their ending inventory, the 12 units that are left, okay, are the most recent ones that were purchased. Those most recent ones that were purchased were for $1,450. They can then figure out their cost of goods sold by taking the $3,000, subtracting the $1,450, and finding out that the cost of goods sold is $1,550. So that's how we would go about doing it for FIFO. And finally, for LIFO. LIFO, we work exactly the opposite. We have 12 units left in inventory. The ones that came in the last were the ones that were sold. So the ones that are still sitting there are the oldest of the units. So I have to account for 12 units in inventory. So I look at what have been there the longest. And the ones that have been there the longest were the 10 units in beginning inventory at $80 for a total of $800, plus plus 2 of the units from the March 1st purchase at $90 for $180. So the ending inventory value under LIFO is $980. So what we need to do then to figure out the cost of goods sold is take the $3,000, subtract the $980, and we will get $2,020 as the cost of goods sold. At this point, international accounting standards prohibit the use of LIFO. As I've mentioned before and mentioned in the last video, most companies today, even here in the US, are using FIFO, so that's really not an issue. If we ever got high inflation again and companies wanted to switch over to LIFO, it could be an issue for those companies that are required to report under IFRS. Right now here in the US, we still do not use IFRS reporting standards. I can't stress to you enough the importance of accurate valuation of inventory. So often, and these are great jobs for college students to get jobs to work a couple of nights, you know, in January, February, or what have you, to go in and count inventory. But so often, you know, these individuals may or may not care. You know, what's the difference if it's 100 units or 105 units? You know, does that really matter if there's 100 shirts or 105 shirts? What, you know, and the problem is from an accounting standpoint, it matters, and it's important not because it only impacts this year, but it impacts the following year. So if I miscount the inventory, it not only impacts this year's financial statements, but it impacts next year's financial statements. And you can see here, depending upon whether ending inventory is understated or overstated, it not only impacts this year's financial statements, but it impacts the following year's financial statements. Unfortunately, what happens is from time to time there are thefts overnight, there are fires overnight, and the question then becomes, how much did I lose? And if you've ever talked to a small business owner that had a fire or whatever, he always claims he's getting cheated by the insurance company because it cost him more to replace it. And having worked in insurance, they have to come up with a value for that inventory. And there are 2 methods to do it. One is the gross profit method. There's also a retail method. And because we have to determine how much is kept, how much was lost in that fire or what have you. There are 2 ways to do it. And the first one I'm going to talk about here is the gross profit method. And in this particular method, we determine the cost of goods available for sale. And we can find that out. We have accounting records that we know what our purchases were during the year, what have you. Even if we didn't keep our records off site, theoretically we could collect this data by going back and looking at check statements, what have you. Quick note, everyone should back up their data off site every night. Because if you back up your data off site every night, you can provide a lot more detailed information to that insurance adjuster, what have you, and have a much better chance of obtaining the full amount of your loss. You can then estimate the cost of goods sold by multiplying the net sales by the cost ratio, and then you can deduct the cost of goods sold from the cost of goods available for sale to determine the ending inventory. And that's a lot of words. Let's see how it works. So we've got this store, Metro Hardware. Beginning inventory was 50 grand. During January, net purchases amounted to 20. Net sales totaled 30. If their gross profit is 40%, what's the estimated inventory on January 31st? The thing to think about here is suppose there was a fire on January 31st. Okay. Notice I can get the beginning inventory value from my year-end balance sheet. That's no problem. I can find my net purchases by the amount of checks that I've written for my purchases during the month of January, so that's not a problem. I've made deposits every day, presumably, so I know what my net sales were during January, and I can determine what my gross profit margin is, and I probably know that from the off the back of my I know that probably that's number that's probably ingrained in my head, so I've got that 40%, and you can always check your income statement from last year to find out what that was. So all the numbers here, even if there was a fire, should be obtainable. So notice what we're going to do. We're going to take the 50 grand, which is our beginning inventory, add our purchases, of 20 grand, for goods available for sale of 70 grand. Okay. Our net sales in this case were 30 grand. We know that our cost ratio is 60%. Now, the reason why we know that is because our gross profit is 40%, and our gross profit, since our gross profit is 40%, the cost ratio is the complement of that, so it's 60%. So what happens is I take the net sales of 30 grand, multiply and times that 60%, that complement, that tells me it's 18 grand, and that tells me my estimated ending inventory at the end of the year is 52 grand. So when the fire came through and wiped out my building, I'm going to go ahead and tell the insurance adjuster that my loss of inventory was, in this case, 52 grand. There is also a retail method. Both methods may be used depending upon the particular situation. Okay. And this is a little bit more detailed, but it still has much of the same information. Notice what they have here. In this case, I've got an example where the merchandise offered for retail sales at $1 million. Its cost is 450 grand for the year. Ending inventory has a total value of 300. What's the cost of that ending inventory? What I need to do is I need to take the goods available for sale at cost, and usually, and I think your book has it this way, they have it in a table type format. Okay. The goods available for sale at cost is 450 grand. Goods available for sale is $1 million. So my cost ratio is 45%. Okay. Keep in mind that means that my gross margin is 55% because of the complement. I then have taken a physical inventory count of 300 grand, and I've come up with an estimated inventory cost at cost is 300 grand times 45% or 135. I can figure out if in the event of a fire, I could have figured out all these numbers and kind of worked backwards into them. So I can do just like I did with the gross profit method. I can figure out what was lost in a fire, what have you, using the retail method. It's a little bit more complex, but it can be determined. Couple of things that are a couple of ratios that are good to know and that we frequently talk about in business. One is the inventory turnover ratio, and this is how many times does our inventory go in and out the door. A lot of times what they use is they'll use cost of goods sold as the numerator. In the denominator, they'll use average inventory, which means they'll take the beginning inventory, add the ending inventory, and divide by 2. It's the best I have and the best I can calculate for what's my average inventory during the year. This inventory turnover ratio is going to be a number, and it's going to be a number. Presumably, I would, if it's less than 2, you're in trouble. Perhaps for a jewelry store or a furniture store, it might be as low as 2. And what that tells me is that I sell the items on average twice a year. Okay. If it was 12, it would say that I had them on sale or I sold them approximately 12 times a year. When I think in terms of a jewelry store or what have you, it might be as low as 2, a furniture store. If I'm thinking in terms of a grocery store, good Lord, I want to see that number, and I've never looked at what a number is, but at least 12. I want to know that that stuff is on the shelf no longer than a month. It's probably even a lot higher than that. I mean, I can imagine some of those boxed goods and some of the frozen goods may not turn over all that often. But man, those fresh fruits and vegetables and meat and whatever better be turning over about every week. So, I mean, that inventory turnover ratio may be, even closer to 40 or 50, meaning I turn over my entire store once a week. Notice then we can take that 365 in that average days to sell inventory, divide it by the inventory turnover ratio, and it'll tell me the number of days it takes to sell my inventory. In reality, it's not that difficult. If my inventory turnover ratio is 2, that means I turn it over twice a year. It means on average the stuff is sitting on my shelf for 180 days, 365 divided by 2. If suppose my inventory turnover ratio is 12, it means I'm selling it about once a month, which means it's probably about 30 days. So I can easily go from my inventory turnover ratio to the average days to sell inventory. Okay, here's a calculation. Notice what they did, 6.3 means I'm selling it about every 2 months. Okay, it's turning over 6 times a year. And in that case, it's about every 57 days, which makes perfect sense given the numbers that I was discussing earlier. Okay. Another ratio we look at, and notice we have our receivables turnover. And once again, this is how often do we collect our money from our receivables? And here we take net sales. Sometimes you'll see net credit sales because cash sales have no turnover, and divide it by average accounts receivable. So, I mean, it could be net credit sales, could be net sales, depending upon the item. Once again, that's going to give you a number probably between 2 and 12. Okay, and then you can turn that into the number of days it takes to collect your receivables by taking 365 dividing by the receivables turnover. Keep in mind, if your receivables turnover is 2, that means we're turning over our receivables over twice a year. That means on average, my customers are paying me about every 180 days. To be quite honest, that stinks. That number should be, a receivables turnover ratio should probably be about 12. Okay. And keep in mind, if that receivables turnover ratio is 12, that means my average days to collect receivables are about 30 days, which means that I'm collecting my receivables approximately in 30 days, which is probably a pretty reasonable number in the grand scheme of things. That concludes the lecture for Chapter 8. If you have any questions, please feel free to let me know. Thank you.